Some business news now. Strong hiring in the United States is giving Asian markets a reason to worry. Foreseeing the figures as a sign that more rate hikes are on the way from the U.S. Federal Reserve. Exchanges in China and Japan are down as a key private sector indicator of U.S. employment saw nearly 500,000 new jobs created in the month of June. Now, some of this hiring represents seasonal summer jobs, but it also comes as recent deliberations by members of the Fed's board suggest that rate increases are on the way. Now, that could dampen U.S. consumption of exports from Asia. We know that inflation is down from its peak last summer, but still hovering at around 5%. And we all know that is above the Fed's 2% target. All right, for more on this, let's go to Jameel Ahmad. He is in London. He is the chief analyst over at GTC Brokerage. Good to have you on the show. All right, we all saw declines in U.S. exchanges in overnight trading. What do you think we can expect in terms of the opening bell ringing in New York in just a few hours?
Essentially more of the same, and that's because the greenback, the US currency, continues to stand tall. As a result of 2023 was supposed to be the year that we had a relationship breakup away from the dollar, following the significant strength that US markets, economy, and the greenback showed in 2022, despite the highest interest rate policy that many of us have seen in our lifetime. In fact, the US Federal Reserve, as you pointed out, raised interest rates at the fastest pace in a generation. But despite this, US economic data, specifically when it comes to jobs numbers and the jobs report, continues to perform like a shining star. It's expected that later today that we have a possibility the private sector alone increased jobs by 500,000 last month. I don't expect the real number to be that high, but that shows that despite such high interest rate policy in the US, there is still resilience in the jobs market, which is important for the economy because the consumer and domestic spending make up the largest component of the US GDP.
Let's also talk about what else the Fed could be considering, because we've seen energy prices decline, supply chains returning to something like a pre-pandemic normal. Do you feel that the Federal Reserve has indicated that it believes that a tight labor market and low unemployment figures are what's keeping inflation somewhat sticky in the country?
For our summer holidays, what we all wanted to hear was the Federal Reserve signal to the market that interest rate increases in the United States has not only come to a pause, but that we can expect a downturn in lower interest rate policy. As a matter of fact, the US economy has shown so much resilience, specifically when it comes to the jobs numbers. The Fed, which is the US central bank, are suggesting that interest rates might still go a little bit higher in the US. And that's because although inflation has come down to an annualized level of about 4%, which is more than half the 9.2% peak of June 2022, it's still significantly above the 2% target, and it's still historically high, which is why the Fed, the US central bank, are indicating to the markets that they might still need to raise interest rates further, despite such an aggressive tightening over the past year from near zero to interest rates as high as 5%. Again, something we haven't seen in a generation.
All right, great stuff. Jameel Ahmad, thank you very much for joining us here on the NewsHour. I do appreciate it. Thank you.